Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. My name is Syed Haji Al-Junid bin Syed Hassan. My student ID number is 2024-698424. So today I will be talking about the risk return trade-off. So what is the risk return trade-off? The risk return trade-off is basically an investment principle that indicates the higher the risk, the higher the potential reward. Investments with high risk tend to have higher returns and vice versa. Another way to look at it is that for a given level of return, it is human nature to prefer less risk to more risk. Therefore, the higher the risk on an investment, the higher its returns have to be to attract investors.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Zaidani Adib bin Nur Zarizal. My student ID is 2024226214. So next we move on to the systematic risk versus unsystematic risk. So systematic risk is also known as undiversifiable risk. So the risk cannot be eliminated by diversification. It is an uncontrollable external risk which occur due to external factors. It will affect all securities in the same manner. For example, economic, recession and war. So next is unsystematic risk, also known as diversifiable risk. The risk can be eliminated through diversification. It is a controllable external risk which occur due to internal factors within the firm itself. Risks are unique to a firm or industry and will only affect the firm alone. For example, mismanagement of company and labor strike. So that's all.
Imagine, you want to buy something, I want to sell something, and somehow we magically end up agreeing on one price. Nobody tells us what the price should be, but somehow the market figures it out for us. That magic is not actually magic. It's what we call the market mechanism. Hi, my name is Fada Farihis Danuris bin Muhammad Rimi, 2024401802. A market mechanism is basically the system that let buyers and sellers interact in a way that the market can self-organize. And when this interaction happens, three important things come out of it. First, we get price discovery. Every transaction reveals new information and push the price closer to what the market thinks the asset is worth. Second, we get resource allocation. Money, goods and services naturally flow to the people who value them the most. The third one, the market creates liquidity. So people can buy or sell easily without waiting forever for a buyer.
My name is Muhammad Safan bin Hazidan, student ID 2024287418, and I'll be explaining the regulatory rules in managing market risk. Regulators such as Bursa Malaysia and the Securities Commission act as the safety net of the financial system by ensuring stability, fairness and investor confidence. They doing so by performing 5 key functions. The first being oversight and supervision. They license and monitor brokers, exchange and clearing houses to make sure operations are safe, well managed and supported with enough capital. Second, they make out rules and enforcement. Regulators set disclosure and governance rules to reduce information gaps by preventing fraud, and they enforce the rules strictly. Third, market surveillance. They use real-time monitoring rules to detect abnormal trading, insider trading and market manipulation before this activity disrupt the market. For the fourth one, which is systematic risk control. This includes setting limit on large position by imposing margin requirements and requiring financial institutions to conduct stress tests to prevent widespread financial contagion. And the last one, by investor protection. They ensure fair trading practice and healthy companies, and provide investor education to help people to make well-informed decisions and reduce panic-driven volatility.
Hi, my name is ASSESMENT and my student ID is 2024407974. And in this part of the video, I'm going to talk about matching risk profile to different instruments. So first of all, what is risk profile? Risk profile describes how much risk as an investor is comfortable to take. As an investor, we want to reduce the risk as low as possible so we could secure more profits. So there are three types of risk profile. Risk averse is the first one, which is the conservative type. They require high return to compensate high risk bond. For example, we could see like the saving accounts and investing in government bonds. And the second one is the risk indifferent or neutral. This is the moderate type, and it will be satisfied even if they only get the principal that they invested back. So for the example for this kind of risk is the corporate bonds and sukuk. So the reason corporate bonds is risk indifferent and the government bonds is risk averse is because investing in government bonds are more secure than investing in corporate bonds. So last but not least is the risk taker. The risk taker is the aggressive type. They are willing to accept low return for a high risk taken. For example, is a businessman, crypto and forex. I think this is all from me. Thank